Hello everyone. Well done on completing Module 5 of the program. I hope you enjoyed the module, and I hope you enjoyed the live session that we held last Friday. This last week, we started off by revisiting the 4 rules for evaluating trading models, and we looked into a little more detail into each of these rules. We heard from Steve Mobbs, who talked about due diligence and various things to consider when allocating money to an algo fund. As he said, you generally look for very similar things to what you would look out for with discretionary trading. One of the key issues with algos is to look out for when the model stops working. When do you accept that the market is right and the model is wrong? Steve also talked around issues such as fat fingers and the ways that trades get executed. And he also warned about being aware of what systematic trading can and can't do. There are certain advantages, such as size and diversification, but there are also certain drawbacks. Steve went on to talk about evaluating an algorithmic fund. The first thing he does is evaluate the person, understand their thought processes, and understand how they conduct their research. Check that they have tested the model. Check that the model really adds value, that it's not simply doing something that has been done before. He also emphasized it's important to understand the economic rationale behind the model and to be able to explain the key strategy relatively simply, even if the model itself is relatively complicated. Following on from the Steve Mobbs videos, we had some interesting discussion on the algo ecosystem and the benefits and challenges that different players within this ecosystem face. We looked specifically at 3 individual profiles and discussed how they might interact with one another and the likely success of such interaction. As a number of you mentioned, the 3 individuals possess quite diverse skill sets, and it may be difficult to find common ground. One challenge will certainly be whether these individuals can agree on which ideas to pursue. And indeed, more generally, a challenge will definitely be effective communication amongst the players. It will also be important to identify where the gaps between the skill sets lie, and to identify suitable partners to work with who can contribute the necessary skills and experience to fill these gaps. We also had some good discussion in the forum surrounding your own backgrounds, with a number of you mentioning you have a discretionary background, but are eager to extend your skill sets to other areas, such as coding. This opens an interesting debate as to whether traders should strive to be more generalist and attempt to be proficient in many disciplines, or whether traders should focus on one specific area and attempt to be the best they can be in that particular area. Perhaps a good position would be somewhere in the middle, where a trader focuses primarily on one specific area, but also has an overview of the whole process and a basic understanding of the other key disciplines. This is a very subjective issue, and a lot will depend on the particulars of the situation and of the people involved. After our discussion on the ecosystem, we changed focus and we looked from a fund's perspective. Professor Valkens spoke about issues such as capacity and trade sizes, relationships and trust, and also monitoring how drawdowns are dealt with. We then heard from Professor van Mattenheim about his experience in opening a new fund, and this sparked good conversation in the forums regarding how you would consider launching your own fund, specifically whether you would look to use your own capital or whether you would use an incubator. Most of you seem to favor the incubator approach. As you mentioned, with an incubator you don't put your personal relationships at risk. You have access to experienced professionals and a large pool of potential investors. You also have access to physical locations and infrastructure, and you have the opportunity to keep your operating costs low while you build up a good marketable track record that you can then take to potential investors. That said, there are a number of advantages to using your own capital where possible. Using your own capital sends a strong signal of confidence in your own fund to other potential investors, and it also allows you to maintain more control over your fund, both from an operational and a cultural point of view. One thing to bear in mind when providing your own funding is whether your trading strategy is going to be scalable, whether you can scale up and work with larger amounts of money if it does turn out to be successful. As a couple of you mentioned in the forum, deciding whether or not to use an incubator will depend very much on the type of person, particularly with respect to attitudes towards risk, as well as the person's financial position and experience, and indeed actually the experiences of those other people within your network who you might draw on for capital. Finally, we then finished off the module with 2 videos from Professor Vulcan highlighting the main evaluation concerns that investors are likely to have both before and after investment. And that's really it. I think both of the discussion forums we had in this module were great platforms for you to learn more about your fellow participants, with many of you writing about your personal experience and your professional backgrounds. I would encourage you to read through these forums if you haven't already done so, as I think they are a great way for you to make connections with your class within your class group and to learn from the personal experiences of your classmates. I hope you enjoyed the module, and I look forward to working through the final module with you over the next week.